What's going on, everybody? Welcome back to another video where I go through a trade using the ICT silver bullet model, explaining it to you guys from A to Z in order for you guys to implement it into your own trading. So without further ado, let's get right into the video. Now, I'm actually going to be showing you guys a criteria that I personally use every single day in the markets. Now, this criteria is numbered from 1 all the way to 10, and I must see every single step of these actually occurring and happening in the markets for me to have an A+ setup. So I'm going to run through these things with you guys today and show you what these things are. So before every single trade, I want to see a buy side or a sell side liquidity level getting swept. Preferably, I want to see a previous session high or previous session low getting swept, such as Asia highs or Asia lows, or previous day high, previous day low, or even London highs or London lows. Now, it's very crucial to have one of these previous session liquidity levels getting swept in order to have a high probability trade. Now, previous buy side and sell side liquidity levels getting swept during the AM session, New York, is absolutely fine. However, they're not going to be producing the most high probable trades going in your favor. So that's why I always recommend having a buy side or a sell side liquidity level getting swept from a previous session. Now, London session starts from 2 a.m. all the way to 8:30 a.m. Now, just keep in mind, guys, this is all going to be in New York time. So make sure when you get into your trading view or any other platform that you use to change your time from not your local time, but rather to the New York time, because everything that I'm going to be referring to time-wise is going to be in New York time. So having said that, the London session starts from 2 all the way to 8:30. How do we measure our London highs and our London lows? Well, simply this period right here, from this vertical line to this vertical line, we just simply see the highest point and we just put a vertical line on top, okay? That's how simple it is. Now, same thing with the lows. We put a London low right here and put a vertical line below. Now, same thing exactly with the Asia session. Now, Asia session starts from 18 o'clock all the way to 2 a.m. So same thing, we draw a line and a line, vertical line from that period to that period. So we could know that that is the Asia session. And again, the highest point is marked out and the lowest point in that time period is marked out. Having said that, it's going to be marked out as Asia highs and Asia lows. So in this scenario right here, we have a buy side liquidity level, which happened to be in this scenario going to be London highs. We do get that London high level getting swept. So having said that, we're going to be looking at number 2 on our criteria, which is going to be a swing low to be created. And the reason why I want to see a swing low created is because step number 3 and step number 4 are actually correlated to that swing low. Without step number 2, which is a swing low, we cannot actually go on to step number 3 and step number 4. So having said that, we do get this swing low created right here at 10:35. Now, following that swing low, I want to see a market structure shift and a displacement to the downside. And the reason why I obviously want to see it to the downside is because after sweeping a buy side liquidity level, I want to see price returning to the downside and seeking some sort of sell side liquidity level, and vice versa. If price swept a sell side liquidity level, I want to see price reverse and actually seek some sort of buy side liquidity level. So in this scenario here, I want to see a displacement and a market structure shift to the downside. And essentially what a market structure shift is, it's pretty much a candle that closes below this swing low. Okay, so it's a candle or a series of candles that close below this swing low right here. So as we can see, if we zoom in, we do get this candle right here at 10:38 close below this swing low right here. So that is considered to be a market structure shift. Now, a displacement is pretty much within that market structure shift. It is a big impulsive move in this scenario to the downside. So after getting that market structure shift and displacement to the downside, the next thing I want to be looking for is a fair value gap to be created. And it's actually very crucial for that fair value gap to be created because I need that fair value gap in order for price to trace in, then I'll be going short. So having said that, we do get this fair value gap right here created at 10:40, and then we get a retracement into that fair value gap at 10:44. But the issue here we do have is that it's not in the macro. Now, what is the macro? The macro is 2 30-minute intervals in the AM New York session. The first one being from 9:45 all the way to 10:15, and the second being from 10:45 all the way to 11:15. Now, it's very important and crucial to actually have your executions done inside of that first or second AM macro. And the reason being is because price tends to actually make a run and seek key levels in the markets. So having said that, our 6th point on our criteria is going to be a retracement into the fair value gap. That's where we actually are going to be executing and going short. But our first retracement actually occurs at 10:44, which is just a minute outside of the 2nd AM macro. So we wait for the macro to start at 10:45, and as we see, we actually do get a retracement into that fair value gap at 10:45, and that's exactly where we're going to be entering short just as soon as price comes back and retraces into that fair value gap. As we could see right here, we literally tap into it by the pip. Now that we're in the trade, we're going to be placing our stop loss. Our stop loss is actually going to be above the nearest swing high to the left of us. So in this scenario here, the nearest swing high to the left of us is going to be the 10:35 swing high. So I'm going to be placing my stop loss above this swing high right here. Now, you don't want to be risking more than 30 handles per trade. And obviously, make sure you are using the correct dollar amount risk per trade according to your account size if you guys are trading prop firms or even on a live account. Now, quickly before I move on to our take profit targets, the reason why I put my stop loss above this swing high right here and not, for example, above this candle right here, risking less, is because there is actually a theory behind it. Now, if price does want to actually make its way to the downside and lower, it will not actually go above this swing high. And the reason being is because if it does want to keep on going to the downside, it's going to be making lower lows and lower highs. So what that means is we see this swing high right here. The next swing high is going to be lower than this swing high. Same thing with the lows. This swing low, it's lower than this swing low, lower. So it's going to keep on going to the downside. Now, if it does want to actually keep on going to the upside and decide that it wants to actually start seeking higher prices instead of lower prices, then price is automatically just going to keep on going up and absolutely neglect that swing high. So that is going to be just considered to be our protected swing high, and that's where we're going to be putting our stop loss in this scenario. Now, coming in and talking about our take profit targets, we're going to be targeting obviously the lowest hanging fruit. And what I mean by that is the lowest thing that we see that price is going to be most likely taking out is going to be this swing low right here. That is minor sell side liquidity. Okay, so we're going to be targeting that first, obviously, because that's what price is most likely going to come in and take. It's going to be the lowest hanging fruit. We don't want to be targeting something like this, which is obviously, again, definitely a sell side liquidity level, but it's way too far. Price might not come and take it out. So we always want to be targeting the lowest hanging fruit in order to actually make those profits, and rather than actually risking and going for the home runs. You always want to be looking and targeting the lowest hanging fruit and something that usually gives you a 1 to 2 risk to reward. Usually a 1 to 2 is the most ideal in those trades. You want to be looking for a 1 to 2 most of the time. Now, another place where you guys could take profit is obviously the equilibrium, which is the 50% of the range. As we can see right here, we do have this big run up. Okay, so marking the top of that point and marking the bottom of that point gives us actually a range, and 50% of that range is called the equilibrium. Now, price is most likely going to tap into that equilibrium, and under that equilibrium is going to be called a discount. So this part right here where I'm hovering my mouse over is called a discount. And this part right here is going to be considered to be a premium. So price moves from premium to discount and from discount to premium. That's just how simply price moves. So we're actually going to be targeting an inefficiency, which is, in other words, a fair value gap below that 50% range, which is going to be considered a discount. Okay, so we could obviously target 50% and 50% only. And most of the time, we could also target the edge of that fair value gap below the equilibrium. Now, something that I obviously do want to mention to you guys is correlation between the assets. Now, what do I mean by that? Now, ES and NQ are correlating assets, which means both of them pretty much tend to do the same thing, okay? So in this scenario here, we have to always have the same price action or pretty much similar price action. So again, if I see a swing low and a break of market structure on NQ on the left-hand side here, I must see a swing low and a market structure shift as well on S&P 500. If I do not see a market structure shift and displacement on ES, well, I only see it on NQ, this is not going to be considered as a valid trade. You want to see and have both assets doing the pretty much exact same thing in order to have a high probability trade. So as you can see right here, we do get that swing low at 1035, the same swing low that we did get at NQ. And we also do get that market structure shift and displacement to the downside. Again, the exact same one that we did get on NQ at 1038. So that to me is a correlating asset, and that is pretty much a high probability trade. I'm willing to take that trade and put risk on the table because both assets are doing the same thing, which means they're not going to be manipulating. So this is what makes this trade a higher probability of a trade, rather than actually having one asset doing all the confluences that I'm looking for and the other not obeying those confluences. Again, I want to see both of them doing the same thing and showing me those confluences on both NQ and on ES, even though I'm going to be executing on NQ. And there you have it, guys, the ICT silver bullet model right in front of you guys. Now, if you guys do have any questions, let me know in the comments down below, and I'll be sure to get to them within the next 24 hours or less. Now, before you guys go anywhere, I do offer a VIP top trading floor Discord where you guys could come in every single day and literally take the exact same trades as I take and catch bangers like this on a daily basis. And if you guys are willing, the link will be in the description down below. Now, I also do have a free Telegram channel where you guys could come in and I do a mini trade recap on every single trade that I take, whether it's a win, loss, or a break even, just to clarify the model for you guys even more. Again, the link will be in the description for that also. Having said that, guys, I wish you guys have a beautiful one. I love and appreciate each one of you. Until the next time, peace.